Welcome to another Iron Financial Explainer. Today, we are running an absolutely brutal, uncompromising stress test on a true retail giant. I mean, think about the consumer sector right now. It is wild out there. We're seeing mixed signals literally everywhere you look. Major competitors are boarding up their windows, massive cracks are forming in discretionary spending, and credit card defaults? Yeah, they are steadily ticking up. Yet somehow, some companies are still out there pouring fresh concrete and building their structures higher. I'm your lead analyst. I stay focused entirely on the hard numbers, the heavy debt loads, the profit margins, and the sheer structural integrity of these corporate balance sheets. Because here at Iron Financial, we don't do hype. We look for ironclad proof of stability.
Right on. And I'm the Market Skeptic. I'm sitting right here to represent you, the everyday investor. My job is simple. I want to take a hammer, bang it right on the drywall, and see what sounds hollow inside. We're cutting straight through Wall Street's glossy brochures to ask the really hard questions. Like, is this actual real growth we're looking at? Or is it just a temporary pump? Just putting a fresh coat of paint over a crumbling foundation. So before we start drilling deep into the blueprints today, make sure to hit that subscribe button. You're going to want to forge a much stronger portfolio with us.
Okay, let's get right into it. Best Buy has just dropped their May 2026 first quarter fiscal 27 earnings report. Now, in a retail environment that currently feels like it's built on shifting sands, this specific financial report is so much more than just a summary of how many laptops and HDMI cables they managed to push out the door. It serves as a highly critical, real-time stress test for the American consumer's wallet.
Exactly, and that's the real stake here. Are Best Buy's latest financial numbers actually proving that they have a solid, weatherproof foundation? Or are they simply masking deep structural cracks in the broader consumer market? Listen, if the everyday consumer is buckling under inflation or high borrowing costs, Best Buy is one of the very first places we will see that fracture happen. They sell the stuff people want, not necessarily the stuff people need to survive.
That is a great point. So let's roll out the blueprints and examine Best Buy's Q1 fiscal 27 earnings. We need to see what this structure is actually made of.
We need to evaluate the absolute core structural beams of this company right now. I'm talking about enterprise revenue, diluted earnings per share, and comparable sales. Let me aggressively break down these hard numbers for you, because honestly, these are heavy-duty, load-bearing metrics. They demand respect, especially when you consider the brutal macroeconomic climate we're operating in. Enterprise revenue came in at $8.936 billion. Now, that is an undeniable, solid concrete increase from the $8.767 billion they posted in the exact same quarter last year. But listen to this. What really reinforces the steal here is the bottom line efficiency. Diluted earnings per share jumped a massive 38%. It hit $1.31 compared to just 95 cents a year ago. Stop and think about that for a second. You have to understand just how incredibly difficult it is to engineer a 38% earnings jump when interest rates are hovering this high and everyday consumer credit cards are largely maxed out. That absolutely does not happen by accident. Furthermore, comparable sales, which is the absolute bedrock of any retail momentum, swung firmly into positive territory at plus 2%. This is a massive structural reinforcement, especially after seeing a negative 0.7% decline in the previous year. This right here, this entire spread, is exactly what ironclad growth is supposed to look like. And it gets better, because this brilliantly illustrates their margin durability. The operating income didn't just inch upward, it jumped to 4.1% of revenue. That is up significantly from 2.5% last year. When you see operating income holding strong and expanding like that across a massive physical retail footprint, it proves that their cost structures are highly disciplined. Their operational efficiency is locked in tight. They are literally squeezing more profit out of every single brick in the building.
Hold on. Let me step in and interrupt this victory lap for a second. The numbers look really shiny on the surface, I'll give you that. But I have to ask the question every single investor should be asking right now. Is the core business actually growing, or is this just cost-cutting hype? A 38% EPS jump looks fantastic in a press release, but how much of that is genuine organic consumer demand versus just, firing the guy who fixes the forklift to save a few bucks and artificially pumping the stock for a single quarter? We need to look at what's actually moving off the physical shelves.
Okay, that is a completely fair critique. Let's weigh the load and look at the category performance to see what's really happening on the floor. You have the strong beams holding the structure up. We saw very solid comparable sales growth driven by innovation and natural replacement cycles in computing, mobile phones, and tablets. In fact, management specifically noted that the combined computing and tablet categories delivered incredibly robust growth.
Right, sure. But look at the sagging beams. The heavy drag on this entire structure is coming from continuous, noticeable declines in home theater and appliances. You just can't build a long-term invincible retail empire if everyday people are refusing to buy those massive, high-margin, big-ticket home theater systems. You know, the kind that require a contractor and an oversized truck just to get into the living room. That steep drop-off in big purchases, that represents a massive stress fracture in consumer confidence.
And let's not suffer from short-term memory loss here. I want to remind everyone of the cracks in the armor we saw just recently. Let's flash back to the fourth quarter of fiscal 26. Comparable sales back then were down 0.8%. But more importantly, average selling prices, or ASPs, were entirely flat. Let me break down why that matters so much. If your ASP is completely flat while overall inflation in the broader economy is still churning higher, it means you have completely lost the ability to pass your increased costs onto the consumer. Your pricing power is crumbling. And guess what? When analysts pushed management on the outlook for average selling prices, they completely dodged giving specific guidance. They vaguely stated that they focus on offering a wide range of price points to meet customer budgets. Come on, when management avoids giving hard pricing guidance, it usually means the structural integrity of their pricing power is heavily compromised.
And honestly, that's exactly why Best Buy isn't just relying on moving cardboard boxes anymore. They see the same writing on the wall. Let's look at how they are actively welding new profit streams to combat this.
Best Buy's whole strategy right now involves actively reinforcing their foundation, far beyond traditional retail sales. They need to insulate themselves from those exact fluctuations in hardware pricing you just mentioned. This strategic expansion is where all the heavy lifting for future margins is currently being engineered. First off, they are aggressively scaling Best Buy Ads, which is their proprietary retail media network. To put that in plain English, think of it exactly like a digital end cap. Brands are paying top dollar to put their specific laptops or headphones right at the absolute top of the search results on BestBuy.com. Furthermore, they are rapidly expanding the U.S. marketplace to allow third-party sellers directly onto their platform. This isn't just a side project. Management explicitly expects a 30 basis point improvement in the fiscal 27 gross profit rate because of it. Now, a basis point is 1/100%, so 30 basis points means a 0.3% direct boost to their gross profit rate. At Best Buy's massive multi-billion-dollar scale, that represents an enormous influx of cash, directly driven by the growth in these two high-margin capital-light initiatives.
Yeah, but I want everyone to read the fine print on what management actually said during the call regarding these new initiatives. They claim they are, quote, expected to add operating dollars and improve operating income rates in the future, end quote. In the future? Seriously? That's about as vague as a contractor telling you they'll finish pouring your driveway eventually. Exactly how much and exactly when. On the earnings call, they literally admitted they can't really say at this point. I'm pushing for hard timelines here, because vague promises of future ad revenue simply won't offset the brutal structural pressures they are facing on the physical sales floor today.
Well, to address the physical sales floor directly, they are modernizing the entire omni-channel experience to stay ahead of the curve. Let's consider their AI integration. Best Buy is forging very aggressive partnerships with OpenAI and Google to create hyper-efficient AI-driven shopping and checkout solutions. The goal is to completely eliminate friction at the register. Furthermore, they are amplifying a massive partnership with Meta to bring AI glasses and expanded interactive experiences to all their store locations. We are talking about store associates potentially equipped with actual AI-powered glasses. Imagine an associate being able to instantly pull up inventory specs, execute competitor price matching, and access warranty data while looking right at the customer. This is a crucial steel beam meant to elevate customer service and future-proof the entire business against retail obsolescence.
Or is it just smoke and mirrors designed to make them sound like a cutting-edge tech company to naive shareholders? Let's be real for a minute. Expanding into retail media networks and deploying AI brings entirely new, intensely fierce competition. Best Buy is now fighting for brand marketing spend against massive, deeply entrenched digital giants like Amazon and Google. That is a whole different weight class. Furthermore, by expanding their marketplace, they are literally inviting third-party sellers to cannibalize their own sales and compete with them on their very own platform. This severely stress tests the integrity of their market share against unexpected, agile tech players who can maneuver much faster than a traditional brick-and-mortar retailer with a massive physical footprint.
And that perfectly transitions us to the biggest cracks in the concrete right now, the macro headwinds.
Market Skeptic. We need to shift our focus entirely to the macroeconomic stress factors pushing against Best Buy's foundation. You honestly don't have to look far. Their own annual report lays out the brutal macro conditions threatening to bring the roof down on this operation. These are unrelenting macro stress tests. First up, tariff uncertainty. Management specifically cited the unknown levels, the timing, and the specific countries involved regarding tariffs. This directly threatens to skyrocket their supply chain costs. Second, we are seeing major shifts in how frequently consumers actually upgrade their devices. People are holding on to their tech much longer because there simply aren't enough must-have killer features in the newest hardware to justify a $1,000 upgrade. Add in severe memory shortage pricing pressures, meaning the internal chips that go into every single device are suddenly costing Best Buy a lot more to source. That directly squeezes their profit margins. These headwinds are so incredibly heavy that Best Buy previously had to lower their full-year comparable sales expectations to a completely flat range of -1% to +1%. That is zero growth, folks.
But you have to look at the strategic balance and credit management for their defensive engineering. Best Buy maintains a highly disciplined, long-standing strategy of targeting roughly 60 days of forward supply. That deeply tenured operational skill and their incredibly strong vendor partnerships actually shield them from a massive amount of the inventory volatility that routinely crushes lesser retailers.
I'll counter that defense by pointing straight to the impairment charges. They had to take massive impairment charges related to their decision to exit components of the Best Buy Health business in fiscal 26. To put it simply, an impairment charge means they had to admit a multi-million-dollar investment was a complete failure. They had to tear it down and wipe it off the books at a permanent loss to the shareholders. That proves right there that some of these strategic new beams they try to build end up completely failing the stress test.
Okay, fair enough. But there is one underlying steel beam in this structure that absolutely cannot be ignored under any circumstances: the dividend.
Consider this staggering number, $1.1 billion. That is the massive amount of capital Best Buy returned directly to its shareholders through share repurchases and dividends in fiscal 2026 alone. That is enough sheer cash to literally build a small professional sports stadium, and management decided to hand it directly back to the owners of the company. Regardless of the macro noise, the management team is structurally committed to generating deep cash flow and aggressively rewarding the investors who are holding the stock.
And the consistency of that return is ironclad. Look at the number 13. They just announced a 1% bump to their quarterly dividend, bringing it up to 96 cents per share. This marks the 13th straight year of consecutive dividend increases. Think about what has happened in the world over the last 13 years. Through global pandemics, catastrophic supply chain crises, historic inflation that wrecked household budgets, and violently shifting consumer habits, they have fortified and grown this dividend payout. That is a true, undeniable testament to financial durability.
All right, we've thoroughly examined the blueprints, we've aggressively stress-tested the load-bearing beams, and we've inspected the macro cracks. It is time for our final synthesis. The verdict? Solid foundation or value trap? When you tally up the strengths of this blueprint, the foundation looks remarkably strong for a legacy retailer. You have a massive 38% jump in earnings per share, undeniable omni-channel strength where nearly 32% of domestic sales are currently happening online, and they're actively growing high-margin, capital-light revenue streams like Best Buy Ads. They're executing incredibly well on the operational metrics they can actually control. But let's be honest, the heavy lifting still required here is absolutely daunting. You are buying into a company fully exposed to global tariff volatility, unrelenting macroeconomic headwinds, and incredibly weak consumer demand in high-margin big-ticket items like home theater systems. The average consumer's wallet is being squeezed dry by interest rates and inflation, and buying a brand-new, massive 85-inch TV is the very first thing that gets cut from the household budget.
So the crucial takeaway today is this. Best Buy is proving it can tightly engineer profitability out of a very challenging environment. They are maintaining their margins and paying a highly reliable growing yield. But the macroeconomic environment is still raining hard on the entire retail sector. The final question isn't just about Best Buy's balance sheet anymore, it's about yours. Is your portfolio actually strong enough to withstand ongoing retail volatility? If you need a solid dividend and you truly believe in their tech and advertising pivot, it's a structural hold. But if you fear the macro cracks will widen and consumer spending will finally break entirely, you might want to start looking for safety elsewhere. Thank you for joining this Iron Financial Explainer. Keep stress testing those portfolios, absolutely don't buy the hype without checking the structural blueprints first, and we will see you on the next breakdown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.